Snyder, and thank you so much for joining me for the Sane Crypto Podcast, the first cryptocurrency podcast for baby boomers investing for retirement. Most people believe that crypto assets are too risky for the average investor. You've probably heard me say, I believe that the risk is in not investing. And in fact, cryptocurrency may be the answer to near retirees' prayers. The Sane Crypto Mastermind is my signature program for those who want the diversification benefits and return potential of cryptocurrencies, but can't, won't, or just do not have the time to figure this all out and keep up with it on their own. If you'd like to learn more about that, I'd encourage you to join my free online training, which is called How a Little Bit of Bitcoin Can Increase Returns and Hedge Against Financial Crisis. You can find that and register at sanecrypto.com/retirement. Now, I don't know about you, but to me, things are feeling a little bit discomforting. The U.S. stock market has recently given back its gains for the year. Oil had its biggest single day loss in almost 3 years recently, which is very good for us at the gas pump. I think I saw today mine was at like $2.12, but not so great for investors. Bitcoin broke through a key support level and is now down at around 5,000. And there's still a good deal of emotional angst over the midterm elections here in the United States and the bifurcated state of the country. Now, no one knows what will happen, obviously, right? But the Federal Reserve reversing a historically long period of artificially depressed interest rates is probably a good time to brush up on your risk management. So I thought this would be a really good time to share with you what I have learned over a 20-plus year career about protecting the assets that you've worked so hard to create when things get wild. Benjamin Franklin said it best, if you fail to plan, you are planning to fail. So today, in an effort to make this not quite so dry and boring, I am going to expand on a metaphor I touched on very briefly at the tail end of episode 40, which was the debate on Bitcoin as a hedge against inflation and recession. That metaphor is the hurricane house, so named because it was the only house standing on Mexico Beach after the deadly Hurricane Michael came ashore in Florida this October. And specifically, the hurricane house teaches us a lot about, one, how to avoid being wiped out during a recession or prolonged bear market. 2, specific techniques for earning enough return to fund your retirement, even while protecting your portfolio from downturns and crisis. And 3, how this differs from the conventional wisdom and why the conventional wisdom is, as it so often is, wrong. If you haven't seen a picture of the hurricane house, it is really quite remarkable. There, right on the beach, is this really nice, big, white house with blue metal roof and blue shutters, seemingly unscathed, while everything around it is leveled as if by a bomb blast. Although it's formally known as the Sand Palace of Mexico Beach, at least that's what it was known before the hurricane, the press subsequently have dubbed it the Hurricane House. And the reason it survived is it was meant to. It was built to withstand not just 150 mile per hour winds, but 250 mile per hour winds. This recently finished 3-story, 4-bedroom vacation rental was apparently, from everything I can see, really, comfortably appointed. But what made it attractive to renters during good times belied the state-of-the-art hurricane proofing that was hidden underneath. The owners told CNN that it cost something like 30% extra to add this extra protection, and that they specifically built it to withstand, quote, the big one. But they just didn't expect the big one to come so soon. The CNN article says, though its roof and most windows and doors remained intact, the house was not unscathed. The Sand Palace Facebook page said that the ground floor and the stairs up to the middle floor are gone, along with windows in one of the bedrooms. All the utilities will have to be redone, and of course, and one of the heating and air units is gone too. But the point is, relatively speaking, right? The house is still standing, and that was no coincidence. So what can we, as family CFOs, learn from the hurricane house? What must we learn? Lesson number 1 is you never know when or if it, quote, air quotes, is coming. But prudence demands that you design for it anyway. Before Hurricane Michael, the panhandle of Florida, which is where this was, had not seen this sort of extreme hurricane. The conventional wisdom was that storms this strong would only hit southern Florida, that they would never get up to the panhandle. And so after Hurricane Andrew, which was particularly bad in southern Florida, they raised the building codes on the Atlantic coast to withstand 175 mile per hour winds. But the codes in Mexico Beach, again, where this happened, were only for 120 mile per hour winds. But the owners of the hurricane house, they built to 250 mile per hour, way, way, way above code. And they estimate that it cost them about 30% more to build it that way. They didn't assume that it wouldn't hit there. They assumed that it would and designed accordingly. Now, in portfolio design, diversification is the portfolio equivalent of hurricane proofing. If you have never seen the Callan periodic table of returns, I am going to encourage you to stop now and either click through to the image from the show notes, or if you're driving or something, just stop and make yourself a note on your to-do list to go look it up. I will provide a link to it. In fact, I'll just provide the image. It's that important if you've never seen it, and I'm going to refer to it multiple times throughout the rest of this show. The Callan periodic table of returns is loosely based on the periodic table of elements that we all studied in high school. But instead of elements, it shows the returns of each common asset class for each year, stack ranked from best to worst. And it color codes each of these asset classes. So, for example, I know this is kind of hard for me to explain, but just I think an example will help you picture it. So just take on this particular chart, on the left-hand side, 2000, the first column is 2006. In 2006, the highest returning asset class were REITs, real estate investment trusts, if you're not familiar with the term, with a return of 35.1%. Then below that, you have 12 different color-coded asset classes, with the lowest one, last one at the bottom, being commodities with a return of 1.6%. So that's what I mean by stacked ranked. And the chart does this year after year, one after the other. So the next column, 2007, the highest return at the top is emerging markets. And then REITs, this time, 2007, are all the way at the bottom with a return of negative 15.7%. And again, because of the color coding, what you see looks effectively like a patchwork quilt. with each asset class kind of just randomly spread around the quilt. And the obvious takeaway when looking at this patchwork should be that there is no way to predict in advance which asset class will outperform and which will be down. And, just as you wouldn't expect to play winning golf with just a single club in your bag, you can't expect to have a resilient portfolio if you're only holding one or two of these asset classes. It's a disaster waiting to happen. Lesson number 2 is to revisit your risk management strategies periodically and modernize when necessary. Apparently it wouldn't have been that expensive to retrofit the older homes in Mexico Beach with the more modern building techniques and materials developed since they had first been built. We've come a long way since the 50s, right? But if you don't think it's ever going to hit there, then, you probably don't have that big of an incentive. Well, we know when it comes to portfolio design that we have a bear market in the stock market on average, if you look all the way back to World War I, about once every 5 years. In fact, by that measure, you would say that we are overdue. So, the same is true of portfolio management. This isn't your grandfather's 80-20 portfolio of stocks and bonds anymore. There is a whole new world of modern investment strategies, often using derivatives combined with these newer asset classes that provide a much bigger tool set for accomplishing the dual objectives of managing risk and producing sufficient return. If a financial advisor is charging you more than a few hundredths of a percent for managing a portfolio of stocks and bonds, in the modern era of low-cost index funds, you are almost certainly being ripped off. The only way an asset manager can possibly cover their fees these days is by offering you sound alternative investments and or behavioral investment advice. Think of it this way. You wouldn't go to a doctor who is still treating people with leeches and bloodletting, would you? All right, lesson number 3 is it can be attractive, pretty even, but still built to withstand risk. Pictures on their Facebook page show that this was a really nice beach house. I'd certainly have been happy staying there for my vacation. But what you don't realize just by looking at it is it's sitting on reinforced concrete piers sunk 40 feet in the ground, and that even the walls are reinforced poured concrete. Well, likewise, a portfolio built to withstand risk doesn't necessarily have to settle for, quote, ugly returns either. This is a false trade-off many people think that they have to make, either because they just don't understand how diversification works mathematically, their investment advisor is sadly behind the times, or more likely has no financial incentive to go beyond the traditional portfolio, or that you are, and this is common, you're just uncomfortable with investments that aren't familiar, which will cause you to be a little bit slow to adapt. Remember that your goal is to build a portfolio that generates enough income to sustain a reasonable standard of living throughout retirement and keeps pace with inflation. And that is likely going to require a double-digit return over time. This is the thing that nobody tells you. How do you know that it's going to require a double-digit return, or for you, what that required return is? Okay. Let's do this. Let's take some assumptions, okay? We'll say that, let's just imagine inflation will average 3.5% annually over your lifetime, that you will need 5% of your portfolio value each year to live on. That's withdrawals once you retire, that your marginal tax bracket is 32%, which I think off the top of my head is like a joint, the top of that bracket. I think it's like 400 to 600,000, something like that. Family joint filing, married filing jointly. But if it's not, you can plug in your own number. The stock market averages roughly, we'll say 10% over time, round number, and that the bond market averages 5%. Okay, so to figure your required rate of return, what you do is you add your withdrawal rate to the rate of inflation divided by 1 minus your marginal tax rate. So in my example, that would be 5% withdrawal rate plus 3.5% inflation for 8.5% divided by 1 minus your 32% tax rate, or 0.68. So that equals a 12.5% required rate of return, given those assumptions, to give you enough to withdraw money, pay the taxes, and keep up with inflation. Okay? The problem there is that the stock market averages roughly 10% return over time, and the bond market averages 5%, right? So what that means is that traditional retirement portfolio of 60% stock and 40% bond, that your grandfather's financial advisor recommended, is only going to average 8%. And again, I was being really, really, really generous with my assumptions. Okay, 8%. That's a big gap. That's a problem. That's what we call, it's a nice euphemism, known as in the business as risk of ruin. That's a big risk of ruin. And that is why alternative investments, including cryptocurrencies, have such an important role to play in a modern portfolio. Alternative investments generally, though not always, have higher expected returns, are often non-correlated and therefore expected to go up and down at different times than stocks and bonds, and some can even be reasonably expected to provide a hedge against inflation and financial crisis. Now, the trade-off for some of those higher expected returns will be things like liquidity risk, lack of liquidity, or meaning they're longer-term investments, right? Or something that your money is locked up for a period of time, and in return for which you get a higher return, or volatility, okay? Which is exactly why they are part of an overall diversified patchwork quilt portfolio, okay? Lesson number 4 is that it is unrealistic to expect to be completely unscathed when the big one hits. Had Mexico Beach been hit by a Category 1 or 2 storm, the Sand Palace probably wouldn't have even batted an eye. It would be like the story of the 3 little pigs saying to the big bad wolf, "You can huff and you can puff, but you can't blow my house down." But in a violent 150 mile per hour monster, no matter how you plan and what code you build to, some things are going to have to give. Your goal at that point, okay, at that extreme, is to minimize damage. And it's all relative. I mean, you don't care that a window was blown in or you lost an air conditioning unit when your whole town was leveled and people died. Likewise, in portfolio design, some things are designed to give in a storm, right? And other things are designed to hold. If you go back again to the periodic table of returns, and just the one that I am referring to, in case you're Googling this instead of clicking through my link, is a version that covers the period from 2006 to mid-2017. And unlike the Callan table, this one includes alternative asset classes in addition to the traditional one. Again, there's a link to it in the show notes, but shout out to RCM Alternatives for this version, this alternative of alternatives. It's a super useful chart. So the color coding makes it pretty easy to just draw some really quick observations. To this point that we're talking about now, in the years that REITs are gaining 35% or emerging markets 39.8%, you'll notice that defensive asset classes like cash and high grade investment grade bonds and commodities will be clustered near the bottom of the stack ranking. But when things go south, like 2008 and 09 or 2015, those asset classes float to the top of the stack ranking. And that is why you own them. Nothing makes money all the time, okay? And some years when the big one hits, right, everything may lose. But again, that's the exception, and some things a lot less than others, okay? Lesson number 5 is when you do what everyone else does, you will get what everyone else gets. In the CNN article, the owners said, quote, "A lot of people criticized us. Our friends said, why didn't you put more windows in? How many of those friends will rebuild their houses with concrete pilings and fewer windows? I bet all of them, if they rebuild at all." Social proof is so strong. It says that humans, in the absence of certainty, look around, see what everyone else is doing, and do the same thing. And the more uncertain we are, the more we do what everyone else is doing. We are hardwired over millions of years of evolution to be herd animals. We naturally feel safer in the herd, and we don't like to see people break from it. Social proof explains all kinds of horrible things that crowds do. Explains how, they drank the Kool-Aid. Otherwise, normally rational people, social proof, they drank the Kool-Aid in Guyana. It's an amazing thing. But markets don't reward the herd. They punish it. They also don't reward reaction. They reward inaction. Going back to the periodic table one more time, the best performing asset class in 2007 was emerging markets at 39.8% return. Now, how many people do you think bought emerging markets then because they were hot? A lot, I guarantee, a lot. And then in 2008, the next year, the financial crisis hits. Guess which asset class did the worst at the very bottom of the stack ranking? You guessed it, emerging markets, down 53.2%, negative 53.2% as a class. Now, as the financial crisis unfolded globally, gradually contagion spreading from one economy to the next, how many people do you think sold everything they owned in emerging markets? Again, a lot. It was terrifying, right? Why would you want to own that? Especially when the herd was selling, right? So maybe they went, as people did, to cash or high-grade bonds, which were the best performers in 2008 at 1.4% and positive 1.4 and 5.2% respectively. Well, guess what happened in 2009? The very next year. Cash and high-grade bonds are at the bottom of the stack ranking. What do you think is at the top? Emerging markets, up 79%. The fundamental issue with people losing money in markets isn't that markets go up and down, okay? That's what markets do. It's that people chase them instead of just owning it all. And all today in this modern world means not just stocks and bonds, but all, including alternatives, okay? As Warren Buffett is so fond of saying, right, markets are the transfer of money from the active to the patient. And as an aside, right? When did everyone buy Bitcoin? At 20,000. But they hate it down here at 5,000. That's the herd mentality. And it is absolutely backward. So lesson number 5 is learn to think for yourself. Because when you do what everyone else does, you will get what everyone else gets. And what everyone else is getting isn't all that great. Thinking for yourself gets you the hurricane house. Following the herd gets you a pile of rubble. So as always, I hope that helps. If you'd like to learn more about how I think about the role of cryptocurrencies as part of the alternatives basket in my own portfolio, I would encourage you to join me on a free online training that I do each week. It is called How a Little Bit of Bitcoin Can Increase Returns and Hedge Against Financial Crisis. You can register for that at sanecrypto.com/retirement. I'd love to have you join me, and I will be more than happy to explain that in a lot more detail. You can get the full show notes of this episode, including pictures of the hurricane house, links to the CNN article, the periodic table of returns, and the formula for required rate of return, plus links and references at sanecrypto.com/podcast. And finally, if you have a question about today's topic or anything else, just email me at askkim@sanecrypto.com. I read and answer every email personally, as well as answer some of them here on the show. And those, quite frankly, are my favorite shows to do. Everything I say on this show is for educational purposes only. Nothing should be considered investment advice. Past performance is no guarantee of future results. All investments involve risk, so do not, under any circumstances, invest money you can't afford to lose. That is it for me. I am Kim Snyder. I will be back next week. Until then, may the crypto gods continue to smile on us all.